Isaac Newton's famous quote, "I can calculate the motion of heavenly bodies, but not the madness of people," perfectly encapsulates the often unpredictable and irrational nature of human behavior, particularly in financial markets. Though Newton was one of the most brilliant scientific minds in history, even he could not predict the erratic behavior of investors during the South Sea Bubble of 1720, which resulted in his own significant financial loss. In this story lies a crucial lesson. While the laws of nature follow mathematical precision, human psychology, especially in markets, can be wildly irrational and fraught with speculation. In this blog, we'll explore the story behind this quote, its relevance today, and the broader implications of market psychology, speculation, and financial bubbles. To understand the context of Newton's statement, we need to look back at the early 18th century and the financial craze that swept across England. The South Sea Company was granted exclusive trading rights with South America, an agreement that investors believed would lead to massive wealth. As a result, shares in the company soared as speculation grew, much like the infamous dot-com bubble and, more potentially, the development of AI. This period became known as the South Sea Bubble. Newton was not immune to the mania. Initially, he made a prudent investment in the South Sea Company, selling his shares early and pocketing a profit. However, as the frenzy intensified, Newton couldn't resist reinvesting in the stock. This time, he wasn't as lucky, losing what was estimated to be around £20,000. Today, that's around 40 million US dollars when the bubble inevitably burst. The collapse left Newton bewildered, leading to his reflection that, while the universe followed calculable laws, human behavior, particularly in markets, did not. This story has become legendary, not just for Newton's financial loss, but for the broader lesson it teaches about human psychology, market behavior, and the dangers of speculation. Human psychology plays a pivotal role in the behavior of financial markets, often causing massive swings between greed and fear. Behavioral economics has revealed that emotions, cognitive biases, and social pressures can lead to irrational investment decisions, which in turn creates bubbles that eventually burst. Herd mentality. A primary driver of speculative bubbles is herd mentality. When investors see others profiting, there's an overwhelming desire to join in, often ignoring whether the investment is sound. Newton himself fell prey to this when he reinvested in the South Sea Company after seeing others continue to make money. This is also reflected in modern examples such as the housing market bubble of the early 2000s, where buyers rushed into the market fearing they would miss out on profits. Confirmation bias. Investors seek information that supports their existing beliefs and ignore data that contradicts them. During the South Sea Bubble, investors ignored warning signs, choosing to believe that profits would continue to rise indefinitely. This same bias is present today when investors overlook the risks of overvalued stocks because they are fixated on past gains. Fear of missing out, FOMO. A powerful psychological driver in speculative markets is the fear of missing out. Investors are often willing to disregard logic and risk to avoid feeling left behind. This was certainly at play in the South Sea Bubble, just as it was during the cryptocurrency boom in recent years. Newton's decision to re-enter the market was likely influenced by FOMO, as he watched others around him continue to reap short-term gains. Overconfidence. Overconfidence leads many investors to believe they can time the market, or that they have superior knowledge. Even Newton, with his intellectual prowess, was susceptible to overconfidence. After making an initial profit from the South Sea Company, he believed he could do it again, only to find that the same rationality does not govern market dynamics as celestial mechanics. Speculation in financial markets can be a double-edged sword. On the one hand, speculation drives innovation and growth by directing capital toward new ventures and opportunities. On the other, unchecked speculation can lead to bubbles that wreak havoc on economies and individual financial well-being. The dot-com bubble. The dot-com bubble of the late 1990s is a modern-day parallel to the South Sea Bubble. The promise of the internet revolution excited investors and poured money into technology stocks with little regard for actual profitability. Companies with no clear revenue model saw their stock prices soar, only to crash once the bubble burst. Like Newton's experience, many investors were left holding massive losses after chasing speculative gains. The 2008 financial crisis, the housing market bubble, and subsequent crash in 2008 serve as a stark reminder of the dangers of unchecked speculation. Financial institutions bundled risky subprime mortgages into securities and sold them to investors, creating the illusion of stability. When the housing market collapsed, it triggered a global financial meltdown. This crisis showed how speculation can infect an entire system, much like it did during the South Sea bubble. Cryptocurrency boom and bust. More recently, the rise and fall of cryptocurrencies like Bitcoin have showed the speculative nature of markets driven by emotion and hype. Just as promises of untold riches blinded investors in the South Sea Company, many crypto investors overlooked the volatility and risk, leading to dramatic swings in value. While cryptocurrencies have shown resilience, their rise and fall illustrate the psychological drivers of speculative bubbles. The actual dangers of speculation impact on personal wealth. The allure of quick wealth can lead to devastating financial consequences, both at an individual level and for the broader economy. Speculative bubbles often result in significant wealth destruction when they burst, leaving investors with depleted savings, mounting debt, and shattered financial plans. The erosion of personal wealth. When bubbles burst, they can wipe out years of savings in an instant. Newton's loss in the South Sea bubble was monumental for its time, and similar financial devastation occurred during the Great Depression, the dot-com bust, and the 2008 crash. For many, speculative investments make up a significant portion of their portfolios, so when a bubble bursts, they have little to no financial safety net. The psychological toll, the emotional roller coaster of speculation, highs during bull markets and crushing lows when bubbles burst, takes a toll on investors' mental well-being. The stress of watching hard-earned wealth evaporate can lead to panic selling, poor financial decisions, and long-term distrust in markets. Behavioral finance experts emphasize the importance of maintaining emotional control, but this is easier said than done, particularly when fear and greed dominate investor behavior. The long-term economic impact, beyond personal finances, speculation, and market bubbles, can lead to long-lasting economic consequences. The 2008 financial crisis, for instance, resulted in massive job losses, widespread home foreclosures, and a deep recession that took years to recover from. Speculative behavior destabilizes financial systems and can lead to recession or depression, as seen in countless economic bubbles throughout history. Lessons learned: how to avoid speculative mania. The story of Newton's financial loss during the South Sea bubble teaches us several key lessons about avoiding the pitfalls of speculative mania. Stay grounded in fundamentals. One of the most important lessons is the need to focus on fundamental analysis. Whether investing in stocks, real estate, or other assets, it's crucial to evaluate the true value of an investment rather than getting swept up in hype. Overvalued assets will eventually correct, and those who invest based on sound principles are less likely to get burned when markets fall. Diversify your investments. Diversification remains one of the most effective strategies for reducing risk. By spreading investments across different sectors and asset classes, investors can protect themselves from the full impact of a market bubble. Even if one part of the market crashes, other areas of a well-diversified portfolio may hold steady or even thrive. Focus on long-term gains. Speculative investments are often driven by the desire for quick, massive profits. However, this comes with a high level of risk. A more sustainable approach to wealth building involves focusing on long-term growth, whether through dividend-paying stocks, bonds, or other low-risk investments. Long-term investors are less likely to be surprised by short-term volatility. Understand market cycles. Market bubbles and crashes are part of the natural financial cycle. Understanding this can help investors avoid getting swept up in speculative mania. While it's impossible to time the market perfectly, recognizing the signs of an overheated market can help investors make more prudent decisions. Applying Newton's lesson today, Isaac Newton's experience during the South Sea bubble serves as a powerful reminder that even the most brilliant minds can fall prey to speculative mania. The unpredictability of human behavior, driven by fear, greed, and irrationality, continues to shape financial markets. While we may not predict the next bubble or crash, we can learn from history. In today's world, with constant access to information, social media-driven hype, and an interconnected global market, speculative bubbles may form more easily than ever before. By staying grounded in fundamentals, diversifying investments, and focusing on long-term goals, individuals can avoid the worst consequences of speculation. The modern ERI and behavioral insights. At Enki Advisors, we use the Economic Recession Index, ERI, to provide monthly insights into economic health, informed by behavioral data and traditional market indicators. By understanding both the psychological and financial components of market behavior, the ERI helps individuals and businesses navigate uncertain times. Go to www.enkiadvisors.com/ERI. Please subscribe and hit that notification bell.